Welcome to our Investment Update webinar. In this webinar, Tim Farrelly, our asset allocation consultant, will discuss what's happening in investment markets and how that could impact on your portfolio. I'll hand you over to Tim.
6 months ago, we said that the news over the coming year was likely to be dominated by talk of possible recessions, share market volatility, and a bursting of the residential property bubble. As we know, that certainly has been the case for the last few months. In this webinar, we'll discuss the reality behind the news, which is that what we're actually seeing is an all-time high in media-generated volatility rather than genuine market volatility. We'll discuss the big short that got so much media attention in February and how, despite all of this, Australian shares remain cheap. We'll also discuss what to do with those term deposits that may be maturing. Should they be rolled over or should we do something else? But first, let's look at the news. Most of the news has been negative. For example, we've had the Royal Bank of Scotland urging investors to sell everything. And as an aside, since that article was published, the Australian share market has actually gone up by more than 5%. We have also had some fund managers suggesting that bank shares would fall by 80% and that the Australian dollar will fall to 40 cents. Since this one was published in mid-February, ANZ shares are in fact up over 10%, Westpac shares are up over 9%, and the Australian dollar has actually risen by over 5%. It's pretty clear, reacting to these kind of alarmist reports can be very dangerous to your wealth. And every few days, we seem to get more news describing just how many billions have been stripped from the value of Australian shares. The media just loves bad news. And they seem to hide all the good news. If you look at the bottom right-hand side of this article, in the fine print, you'll find that in between the down days, actually, markets have been recovering most of their falls. Shares did fall somewhat for the first half of 2015, but for the past 9 months, they've really just been going sideways. And that's not what you would have expected if you'd just been listening to the news. Yes, the world is full of economic uncertainties, and there have been some big up and down days over the past few months. However, this volatility, when looked at over a 5-year period, as we see in this chart, is nothing unusual at all. And we certainly don't think it is a sign of an impending share market disaster. And when taking a really long-term view, this volatility just doesn't compare with the big bear markets in the past, as you can clearly see in this chart. So let's have a look at the big short story from February, where some hedge fund managers received huge media attention, claiming the Australian property bubble was set to burst and it would bring down the banks in the process. We do have some sympathy with their findings that residential property is overvalued. We too expect that from here, residential property will prove to be a poor investment for the next 5 to 10 years. Having said that, we do not expect to see a collapse unless we have one of the following occur. Firstly, a rapid rise in interest rates, which we definitely do not expect to happen. Secondly, a trigger could be a panic among property investors. It's possible, but it'd be the first time we've seen that from an Australian residential property investors in our lifetimes. Finally, massive overbuilding of the kind that helped trigger collapses in residential property prices in Ireland and Spain, if it were to happen here, could also lead to sharply lower prices. But again, we think that's unlikely as building activity already seems to be cooling off. So on balance, our expectation is for a modest fall in property prices, but little growth from there on, not a collapse. So we don't think property prices will collapse, but even if they did, we think that the damage it would do to the banks would be material, but definitely not life-threatening. The regulator's records show that banks' new home loans from the past 2 years represent just 4% of their overall home loans. That means 96% of loans were made prior to the last 2 years, and those loans have been made on houses that have appreciated in value. This has created a buffer between the size of the loan and the value of the property. So much so, the big 4 banks all report that more than 95% of their borrowers have more than 10% equity in their homes. And in terms of the ability to pay interest, the ratio of interest payments to household income is lower today than it has been any time in the last 10 years. The reality is the banks are well placed to weather a housing storm, and that is if we get one, which we think is unlikely. This is our tipping point table. It outlines what returns you should expect to get from different markets if you invest at different prices. As you would expect, it shows that the lower price you pay for an investment, the better returns you should expect to get. And the more you pay, the worse returns you should expect. Now, all the bad news over the last year has helped keeping prices low, and therefore future returns are likely to be attractive. Now is a good time to be fully invested. What about those maturing term deposits? No one needs to be reminded just how low term deposit rates have gone. After years of being enthusiastic supporters of investing in term deposits at much higher rates than those we see today, we think the time has now come to move those maturing term deposits into bond funds. This is because the rates that companies have to pay on their bonds has gone up considerably over the past year. Even the very best, the most secure companies are paying higher rates. Again, it's the negative sentiment swirling around the markets that's the cause. As a result, we think bond funds are better value than term deposits for the time being. So in summary, we think the extreme volatility is largely a media creation. Reacting to media reports can be dangerous to your wealth. We're comfortable with the banks, even though we don't like residential property as an investment at the moment. We think Australian shares remain cheap, and maturing term deposits should be reinvested in bond funds.
Thank you for watching our Investment Update webinar. If you would like to discuss your investment portfolio, please contact your financial advisor. For more information on investing generally, please visit our website. Thank you.
This webinar is of a general nature only, and the performance figures presented are not indicative of future performance. Given that most people have fairly complex financial situations, you therefore shouldn't take this information as personal advice. Everyone has different financial situations and requires solutions and plans which are tailored to their individual situation, and we will be pleased to provide you with that personal advice if you wish.